Barclays Capital has just released a stark warning over the potential dangers of these sorts of measures. The bank's equity gilt study, now in its 56th year, warns that extreme expansionary policies left to run too long carry with them severe risks. These include economic imbalances, asset bubbles, and making future shocks even tougher to overcome. So Piero Ghezzi, Barcap's head of global economics, emerging markets and currency research, is one of the authors of that report. He joins me in the studio now. Piero, thank you very much indeed for coming in.
Thanks.
So much of the world responded to the global financial crisis by loosening monetary policy, as you say, and that played some role in terms of pulling the world out of crisis. But at what point do these policies become counterproductive, perhaps even harmful?
I think perhaps now already. Our view is that obviously it was right to ease policy significantly, fiscal and monetary policy, following the Great Depression, the Great Recession. But the truth is that the response has not been symmetric now that economic activity is a lot stronger. I mean, we are expecting in Barclays Capital growth of 4.5% for the world in Q1. Which is the strongest expected quarter over the past years. And our sense is that the level of inflation and growth around the globe is not consistent with this extraordinarily easy fiscal and monetary policy that we are seeing.
So which economies are most at risk from their own fiscal policies and need to now adjust or perhaps withdraw stimulus?
I think like the U.S. obviously stands out as one where that combination is particularly stimulating, right? Because the U.S. has hugely expansionary fiscal policy and hugely expansionary monetary policy. Some emerging markets have very easy monetary policies as well.
So if these policies remain in place, we're talking what, asset bubbles, economic imbalances? Tell me more about these risks.
I think the biggest risk in our view is inflation. I mean, goods inflation first. Clearly, I think like what has happened is that during the 70s, right, the market policymakers were focused on short-sighted objectives, right? And that brought inflation to the forefront. In '79, Paul Volcker actually moved from short-sighted objectives to more medium-term objectives. They started to focus on, became more forward-looking, become a lot more focused on inflation, bringing down inflation. At some point in the 90s, in the late 90s, Alan Greenspan probably became a little too self-confident in his ability to actually fine-tune the economy. And again, that generated first a dot-com bubble, then...
Are the same mistakes being made again now?
I suspect there is a big risk at this point, at least the balance of risks is for that mistake to be that tricky, because deflation or depression is no longer an issue right now.
But Fed Chairman Ben Bernanke seems to be playing down the recovery in some ways. He's arguing that, look, it's there. There are signs that we are recovering, but it's not on a firm footing right now. Unemployment's going to stay high for some years.
Well, unemployment is at 9%. Actually, we believe that the medium-term, like NAIRU, let's say the unemployment rate, that equilibrium rate is around 7%. So we are not that far away, right? And you can start to retire stimulus a little bit and still see unemployment.
You don't think it'll endanger the recovery?
I think if it's modest, given the huge amount of fiscal, let's say QE2 was launched when people were worried about the double-dip depression, the recession, and when we were worried about the fiscal stimulus being withdrawn in the U.S. After that, the fiscal actually was eased, and in addition to that, the economy is growing. So I think like this level of QE2 is just not consistent with what we're seeing right now.
So what do you mean when you say massive fiscal adjustments need to be made? How painful is it going to be for countries like the US to stabilize their debt to GDP ratios? What are we talking about here?
I think like what our calculations is among advanced economies, the largest adjustment needs to be made by the US and Japan. In the case of US, it's like around 8.5% of GDP. The case of Japan, 7.5% of GDP. To put it in perspective, Greece needed like a 13% of fiscal adjustment. Obviously, Japan and the US have some more market credibility. The US enjoys the exorbitant privilege of issuing the reserve currency of the world. That gives them a little bit more time. But at the end of the day, that can postpone the adjustment, but it has to be made.
And that involves spending less, taxing more.
A combination of both, right? It's very difficult to believe that just with this level of tax rates, the U.S. will be able to balance their economy. You need to do both.
But doesn't that risk slowing the economy again?
But Yeah, I mean, like that's. I mean, like but you have to do it at some point.
To avoid the fiscal pain further
I mean,
down
I
the
feel
road.
like look what the Greeks were doing, right? I mean, at some point we should be remember what happened in Greece, Ireland, Portugal. At the end of the day, the markets forced them to make a massive fiscal adjustment. This country actually has been more preemptive. They did a very significant fiscal tightening just because they were concerned of the downside risk of being forced by the market. Once you're forced by the market, it's so messy.
And very briefly, the risks if this is not addressed. You're saying inflation is the biggest threat right now. Global commodity prices are rising, oil is rising, food prices are rising.
Exactly. The second, the longer-term risk is if it goes to asset prices and bubbles. That's where you generate the huge distortions into the economy.
Right, Piero Ghezzi, good to talk to you from Barclays Capital. Thanks very much for coming in.